From Jackson Hole for our radio and television audiences worldwide, this is a Bloomberg special interview following up on Jay Powell, Fed Chairman's speech here in Jackson Hole. We have Philadelphia Fed President Patrick Harker joining me, Lisa Abramowicz, and Tom Keene. And we'd like to thank you very much, Pat, for coming out, interrupting your seminar. Rumor has it you're going to cut rates.
Yeah, that's what I hear.
Was it you've been somewhat reluctant. Are you on board?
No, I said the last couple of days that it's time to start a process. And I think it's a process. It's not about a particular number. The process needs to be dictated by the data we see, but we need to start moving rates down. No question about it.
Well, if you start moving rates down, the one thing that didn't come through in the speech is by how much?
Yeah, and again, I think we need to let the data dictate this. I think what matters more than a particular number. Now, I've been out and about my district all summer talking to contacts. And one thing I heard is 25, 50, that doesn't matter so much as commit to a process. Be methodical about the process. In particular, because what I've heard, particularly from the bankers, is they need time to absorb the changes. So don't just stop and start. Don't just do a large decrease and then stop and then start again. Just start a process and keep it moving.
This, to me, really underscores what Loretta Mester was saying, formerly of the Cleveland Federal Reserve, where it makes sense for the Federal Reserve to go by 25 basis points to begin with and then potentially cut more significantly later on, because then you're not signaling to markets that you're going to go much further. Is that what you agree with?
Yeah, and we'll see how things, there are a lot of risks still out there in the economy, in the global economy. So we start with 25 and we just let it run and keep moving. And we're already seeing it, right? We're seeing the long end of the curve start to come down. That's been good. The mortgage business is back. You talk to bankers, they're starting to write mortgages again. That's all good news for the economy.
I've got to ask the engineer the question. Susan Collins was channeling Patrick Harker here the other day. She says, we need to lose the pessimism. We need to be more optimistic about where we are right now. What do you more than anyone I know, listens to business. Yeah. What are you hearing from business about investment next year, about their confidence forward?
Yeah, they're cautiously optimistic, I would say, right now. I think they are optimistic, but depends on the industry and depends on where they are in their own business cycle, right? But yeah, generally we're seeing, take housing, for example. Housing is a good example. We know that a lot of developers are sitting on their hands waiting for rates to come down, for this process to start. I think that's a good thing because we need them to build affordable houses, low, moderate income houses. And I think they will do that as we start this process.
When the chairman spoke today, he suggested that the balance of risks has changed. Inflation is coming down, and it's probably not going to shoot up again because of the rising unemployment rate. But the rising unemployment rate, in turn, is a bigger risk at this point. How much of a risk do you see of downturn from unemployment?
So I don't see a large outside risk. The unemployment can go up some, right? And it probably will go up a little bit. It will definitely, in our view, not peak above, say, 5%. I mean, it will be below that for sure. No, not for sure. Nothing's for sure. But you got to look at the totality of the data, too. It's not just about that number, right? It's about what we're hearing from our contacts, the claims data, the job-to-job transition data. There's a host of data you have to look at.
Well, this is a confidence question. Recessions are always a confidence question. You're talking about confident CEOs that the business is going to be okay, but what do you hear from the average person who could pull back if they see the unemployment rate going up?
It really is a tale of two consumers, to simplify things. Those who have the money are spending the money, they're not that concerned. Low, moderate income households are really still feeling the pain. They're feeling the pain of housing prices, food prices, you name it. So they are very concerned. So it really depends. It's not one size fits all. There's not the average consumer. That person doesn't exist in our economy.
So everyone's talking about this process, right? You talked about that too. This is the beginning of a process. One thing that Neil Dunn noticed was missing was the word gradual from Jay Powell's speech. We can get to that in a second. Do you have a sense of where we're heading?
Yeah, so I like the word methodical. That's what I'm hearing from my contacts. Please just make it so that we know where you're going in a a very clear way, and then you start that process, and don't just stop and start, as I said earlier.
So where are you going?
Well, we're going to go back to whatever that new neutral rate is.
Well, do we have an idea of what that could be?
Yeah, I mean, we don't know exactly what it is. We'll know it when we get there. Let's be honest. You can't know it a priori. Right. But, it's probably something around 3%-ish, or, somewhere around there. But we don't know that for sure.
One of the new things of social media is wonderful people. There's a guy named Triple Net Investor that's out there reviewing empty office buildings trading for next to nothing.
Right.
I got good news. Philadelphia is not on the latest list of this city, that city, and the other city. From where you stand and from all your contacts, and Philadelphia's led on this, where are we on the washout and cleanout of commercial real estate?
Again, commercial real estate isn't a one-size-fits-all thing. So downtown office is what we're talking about. The dentist in the suburban office mall is doing just fine, right? It's that downtown office space. We are starting to see that clean out some. Again, it's going to take some time. Whether it's new businesses moving into that space at much lower rents or conversion. We're seeing a lot of conversion activity as well.
Do you have a confidence that the banking industry is resilient to that conversion?
So far, yes, I do. But it's something we clearly need to keep our eye on.
Well, sticking with real estate, let's talk about the residential side. You were optimistic at the start of the interview here, talking about mortgages coming back. There's been a lot of criticism of the Fed maybe breaking the mortgage market because interest rates rose above what the majority of people had for their mortgage rate. Do you have an idea of what level housing it takes for housing to come back? And does that figure into your calculations of where neutral should be?
Yeah, so we had to do what we did to get inflation under control. So no apologies that we took rates up quickly. I think about my generation, the baby boomers, the largest generation to go into retirement. We're sitting on these low mortgages. We want to move. We don't want that big house anymore. That lock-in effect, it will start to ease as rates come down. And we're already starting to see a little bit of that. Again, I talked to the bankers, they're writing mortgages again, not just refis, but they're writing new mortgages again. That combined with the new supply that'll come on the market, I'm pretty optimistic that we can get there.
This is a critical statement from Mr. Harker, the idea of when the rate comes down, where does the fever step in again? Are you looking in Jackson?
It would take a lot.
It would take a lot.
It would take a lot for that to happen. Another question that comes up now that you're essentially starting the path to rate cuts is, what do you do about the balance sheet? Because in theory, they work in opposition to each other, and it had been sort of the Fed's policy that we wouldn't do them simultaneously, but it looks like you're going to be doing that.
Yeah, and that's okay. I think, again, I've always been in the camp of putting the balance sheet on autopilot, essentially, starting the process, letting it run until we get there. We definitely don't know exactly where that's going to end. The data will dictate when we end that process. I'm okay with doing that because it's in the background, it's running. We need to get back to ample reserves. We don't know what that number is, but we'll know it when we get there.
You got an estimate about when that might be?
I do. But I'm not going to, because it's so uncertain. We had an estimate last time we did this, right? And we were off. So I'm cautious about that.
If he told you, he'd have to kill you. I think that there's this question right now about heading into year end, and Adam Posen was really highlighting this earlier. There's this anxiety about what the fiscal backdrop will do to derail some of the calm, the methodical aspects of Fed policy. I don't know that you can or want to comment on basically what that policy could be, but how much does that keep Fed officials up at night? How much is that part of the discussion, what you have to do to respond to any potential expansion of the deficit that could be inflationary next year?
So I stay out of fiscal policy, obviously.
But you have to respond to it.
But we have to respond to it, exactly. And so I can't speak for the Fed either, but for myself. What keeps me up are many risks. That's one of them, right? There's also, if we see what we're seeing around the world, these conflicts get worse. I mean, that would be tragic, the humanitarian tragedy alone, but the tragedy also to the economy, the hurt to the economy. So there are a lot of risks that keep me up at night. That's just one of them.
Well, but do tariffs worry you more or the deficit?
Depends. It depends. The devil's in the detail. Like, what's specific about the tariffs? What specifically we're investing in terms of deficit? I'm a simple guy. I think if we're investing in something that's improving the productivity of the American economy, that's a good thing. If we're spending money that doesn't do that, that worries me more. So again, it's not just one thing. It really depends on what we're doing.
Well, you mentioned productivity. We had the big revision to the non-farm payrolls this week, but that should raise productivity. You view that as good news offsetting the bad news of lower job creation?
That's an interesting way of thinking about it. Yeah. We were expecting this adjustment. We looked at, in the Philly Fed, we've been looking at the payroll adjustments, and we knew this was coming. It was a little larger than we expected, but we knew it was coming, so that wasn't a surprise. And it's still a good number overall. If you average out over 12 months, we're still doing just fine in the American economy. But there's a risk there. That's why we need to start to take action now.
Well, we'll see you on September 18th. Patrick Harker, president of the Philadelphia Fed, thank you very much for joining us on Bloomberg Radio and Television.